Well, hi. Here's a statement I often get when trading things like natural gas and tricky markets which move in very volatile ways and are somewhat unpredictable. And people will often say to me, well, the funds, the whales, to use that terrible term, the people with big money, they've got deep pockets and they can hold on, they can hedge, they can manipulate the market, and they can get away with being wrong simply by holding on because they've got unending amounts of capital to use. But that's actually not true. I know that because I'm deeply involved in that sort of niche of trading. And also in the past, I've worked for banks. I've been on trading floors and I know exactly what goes on and I know what the limits are for traders. Now, a lot of those traders that you're talking about are often just hedge funds with limited amounts of capital. It's not unending and extremely tight risk rules. And a lot of them work in places like I am here. So a lot of hedge fund traders, prop traders work from home. They've got incredibly tight limits when it comes to risk and managing risk, and particularly when it comes to drawdowns and hedging and floating losses, all that sort of thing. They've got incredibly tight rules. They need to adhere to compliance regulations within the firms that they're working for. And they also want to do well. They want to show good performance. They don't want big drawdowns and or floating losses even. They want to get their bonuses at the end of every quarter or every year or whenever they get paid their bonuses. So they're not willing to take big risks, not willing to risk their livelihoods. Eventually, some of them become more and more risk prone and end up with all sorts of problems like drugs and alcohol as the stress of trading sort of weighs them down. But generally, traders are pretty conservative, and the funds and companies that they work for are incredibly conservative. So you might have a 0.2% risk tolerance on any one trade idea, which means that when your trade gets to that level, you've either got to hedge it or stop it out. Sometimes if you've lost a trade on a particular instrument, you might not want to go back into that instrument for reasons of fear and doubt and anxiety, having just lost a trade on a particular instrument. And some firms might even prohibit that. So when you look at things like natural gas, which we've been trading a lot recently, and wonder how funds are trading it. They don't have unending funds and budgets to take big losses. And when you get to crucial levels like $2 that we're at now, or $1.80, maybe $1.50, a bit lower down, having probably taken quite a lot of losses higher up, some of the funds at $3 and $3.50, they'll be very nervous about selling or buying. That's why you often get these hesitations and a reluctance for people to get back into the market in either direction. There'll be some traders holding on to long positions from $3 or $3.50 and still hoping that the market will go up. And those traders won't be exiting at $2 or $1.80 or $1.50. They've held it this long and they're not going to give up those trades just yet. So that leaves us with this idea that these huge funds can just keep on buying natural gas unendingly, or they'll continue to sell natural gas once it reaches these perilously low levels, well below producer's cost. And that's not the case either. So here we are at the charts, and you've got to put yourself into the mind of these funds and traders. And we're talking about the average run-of-the-mill sort of trader, someone who works for a hedge fund or a hedge fund manager or a prop trader, or someone who's in charge of a hedge fund and is directing other traders. What's happened after a lot of positions were stopped out at $3.50 or thereabouts? Some of them were stopped out, some of them held onto those positions and are still there, and some would be hedged, I would assume, and hold long positions from around $3.50 and some short positions from there. The short positions being in profit and the long positions not so much, depending on the balance of their hedge. And then after breaking down through $3.50, we sort of got down to $2. There would have been funds and traders buying at $2 like I did, and then holding on to those long positions despite the rejection from $3, and potentially still holding on positions which are perhaps marginally profitable or just about break even at the moment. Some of the weaker hands in that group will probably be looking to stop those trades out on a dip down below $2 or $1.90, and then potentially look to rebuy at $1.80 or $1.50. Others will be just holding on to those long positions and hoping for a bounce off lower levels, not wanting to get out of positions that they've already established and held on for so long, all the way back to the middle of February this year. So there'll be traders holding on from $3.50, potentially some traders holding on from $2 where we are at the moment, and also potentially those who went long on a break above $2.50 or $60 into this rally up to $3 and have held on to those positions. So there will be an awful lot of long hands in this market, and I don't think that any of them are going to be giving up their positions very easily. Conversely, we've got some people that will be short from way up at the top around $5 or $6 or $7 and still holding onto those shorts. A lot of those short positions would have been covered when we did rally up through $2.60 or 70 up to $3, and they would not have re-entered those short positions after a break above pretty crucial resistance, and so they won't be adding short positions on just yet. So they're going to be all sorts of tussling in the market. And then someone also mentioned leveraged funds and leveraged positions, which might be long or short at this stage. I don't think we really know accurately where this market is positioned overall. You can look at the commitment of traders, you can look at various reports from hedge funds, and you can look at a variety of news sources from mainstream media like Bloomberg and CNBC and so on. But I don't think we really know where the bulk of these positions are being held, unless I'm completely wrong. There's nothing I can really find on it that would indicate whether the market's largely long or largely short. What we do know, however, though, is that we're at or near historic lows, $2 being the first level, then 180, and then 150. And we do know that we're below producers' costs, and we do know that the median range for natural gas is somewhere between $2 and $3.50, and perhaps a little higher on the extreme, maybe up to $5, and a little lower on the extreme down to $1.50, maybe even $1.40. Somewhere around there. So I just wanted to dispel this idea that there are people with lots and lots of money, funds with huge unlimited resources that can just keep on buying or keep on selling. That is not the case. There are people, actual humans like you and me, they're not all robots, who are trading this market, hoping to get their salary at the end of the month, or their bonuses, or their performance fee, whatever it might be, and simply trying to figure out this market like everyone else. A lot of it depends on these chart levels, producer cost and supply levels, and of course demand. And that's partially dependent on a variety of other factors like weather and geopolitical events. So that's all I really wanted to say in this video. You know my positions. I'm long from $2 now. I'm willing to add to $1.80 and then $1.50. And below there, at some level just below there, I'll look to either stop out this position for a 1.5% loss roughly, or I'll hedge it and wait to see what happens thereafter. Maybe partially or maybe fully. I don't know. I haven't decided. But so far, my target, if we continue to move lower, $1.80 and then $1.50, both levels at which I'll be adding a little bit more to my very small position currently held from $2. I hope you found that useful, and as always, please subscribe to this channel if you enjoy this content and give the video a thumbs up.